Let's come to the topic of the day. The topic is that don't come to the market or stay away from the market if you cannot dash dash dash. What is that dash dash dash? It's basically a resolve to stay invested in the market. So yesterday, the Daily Byte video that we did got a lot of comments, a lot of reviews, positive reviews, and people saw that power of coming in to the markets for long term with SIPs, and the data is very comprehensive and uh, substantial sort of impact can be made to your mind if you go through that video. So definitely look at 11th February Daily Byte. The data will blow your mind away if you haven't seen that so far. So today in that series again we are going to look at some more data of a different kind. So basically, this is a 2 year rolling return. So today, yesterday was we were studying SIPs. Today we are studying lump sums. So and you know very well that unless the lump sum gets timed well in the market, lump sum returns can be very poor. So we are addressing that also. That just in case you are doing lump sum, even then, the history is not so averse to you making some money. um, so a lot of times what happens is that in the last 2 years you made great returns. For instance, here you had 30 to 40%. 2005-6 you had 30-40%. Then 10-11 you had this. Then 14-15 you had 20% returns. Then in 22 you had 40% 2 year rolling CAGR. So all that makes you sort of feel that every 2 years we will get this only. So look at this chart, how this moves. The long-term average is 13.28 of 2 year rolling CAGR average, but the 2 year returns will move away from 40 on the higher side to even negative 18-20 on the lower side. That's the nature of the market. Please understand this. This will help you to internalize what to expect from the market. Now, I mean, if you don't have, let's say, a view for a 10-year view, for instance, for lump sums, then what may happen? Now, let's see this. 10-year rolling CAGR for the last, 33 odd years is the average is 11.5%. So if you remained, invested for 10 years, and that too on a lump sum basis, I'm saying in Nifty. So we are making a lot of assumptions here. Nifty investing versus mid cap, small cap, etc., which will yield better, more returns. Um, we are assuming here returns from the index and not a strategy based on that index. That is another big assumption. So you are taking sort of worst case scenario here, and you are assuming that you will hold on for 10 years. That is the rolling returns. So if you recall, 1992 was Harshad Mehta peak, and index went up like many times in that rally. So somebody who bought at the peak of Harshad Mehta rally, 1992, for them 10-year rolling returns may have been negative, just about. But then in the last 24, 25 years since then, or maybe 23 years, 10-year rolling returns have never sort of gone below 5 or 6% in the worst case scenario. So you could have bought at the highest point of 2008 and put a huge lump sum there. Even then, you would have made 5.5% CAGR. So making the worst mistake of your life and still 10 years later making 5.5 CAGR is not bad actually. You came in at the worst period of that decade. uh, Similarly, it could have been maybe 2010 onwards, 10 years from there. But for most part the average works well in terms of 11.5% on Nifty rolling CAGR. So the 10-year CAGR, basically the percentage of time 10-year CAGR on Nifty, which is greater than 20%, is very low. So to expect from the large cap Nifty space any major returns is probably not happening, 0.34% of the time. But a significant part of the 10-year CAGR on Nifty has remained in the 5 to 10 or 10 to 15 or 15 to 20% range. That is the 90% sort of data point for Nifty returns. And below 0%, there is less than 1% chance. Below 5%, there's a 9% chance based on the history. So significant confidence is there on the region of 5 to 20% sort of CAGR if you are holding on for 10 years with a lump sum payment. Again, I'm saying this is a very conservative approach because you are assuming you are coming in at the worst time and you never add more. Uh, so that's sort of the thesis that you're coming with. So what are we analyzing today? We are analyzing streaks. What are streaks? Streaks are how many consecutive months are there where 10-year CAGR has been below 10%, below 5%, below 0%, or above 10%, above 15%, above 20%. That is what we're going to do some data analysis on. So if we were to consider, uh, a 10-year CAGR less than 10%, if you came in with lump sum at any point of time, then only 52 months, from July 2001 to September 2005, again, because of that Harshad Mehta impact, if you came in at that peak in 2001, 2, 3, in 92, 93, 94, 95, would you sort of have a CAGR less than 10%? Then from '05 to 15, there was no such period where your CAGR was less than 10%. And then again, for some periods of time, you had your CAGR less than 10% for about 20 months here. If you look at CAGR less than 5%, then there were only 17 such months uh, from January '02 till May '03, where you had for 17 months you had to bear this less than 5% CAGR, and for 11 months right here. After that, you've never had that come again in terms of the poorness of the outcome. For less than 0%, you only had almost like one instance where, again, because of the Harshad Mehta peak, where you bought at Harshad Mehta peak 1992, and for 2 months in April 22, you had to bear a 10%, a 0% CAGR for the last 10 years. Post that, you would have started making money on that. So the summary here is that the longest that you've had to bear not getting a 15% CAGR was 118 months, but 10% or less was just 52 months, right? Out of this entire period of 20 plus years to 30 plus years, you only had few months of period where you had very poor outcome of the Nifty going below 10%, let's say. So now let's look at the stronger side, where we are looking at more than 10%. So here, of course, the mirror image is coming where uh, this entire period '05 till 15, and then from 21 till now, you had a streak of 10-year CAGR being more than 10%. If you look at 15%, you had some periods here, 29 months where you were able to get more than 15%, but then that has not happened since then. And then, of course, the last one is probably 20% that happened only once for 1 month, because your base of 2003 was so low that you made 20% CAGR on Nifty as well. So while lump sum investing has a huge sort of ramification in terms of returns, they don't look as good as what we saw yesterday in the SIP analysis. But even if one does lump sum amounts, or has done lump sum amounts and is now worried, uh, there is there can be a poor outcome, but there is no need for worry as such that whether your capital is at risk, etc. From a index perspective. So if we see the strongest streak point of view, you would find that the longest streak, more than 5%, is so much, so many months. More than 10% is also very very long streak. More almost 10 years. More than 15% has been less, but more than 2 years, and more than 20% was sort of a freak outcome because of a flat market in 2003. So if index can do all this, if lump sum investing can do all this, then if you are in a active strategy which is designed to beat these indices, uh, and if you are able to bring in your money minus the lump sum basis, the returns can be phenomenally well. And I will again say, uh, compare today's data with the SIP data that I presented yesterday and draw a lot of inferences on that. So extreme downturns are short-lived. This is extremely clear once you look at last so many years of data. The downtrends are in fact becoming shorter and shorter. 20 years back, downtrend used to last for years together. 10 years back, downtrends started to compress, and now downtrends are even more compressed. I don't think any downtrend is now lasting a year or more or so, like that. Maybe a year and a half at best. So the outcome is actually in the favor of somebody who remains invested in the market. Consistency, of course, matters, not timing. Exceptional returns, especially in the case of Nifty, etc., are possible, but they are rare. So yeah, the expectation of returns should be according to the vehicle you've chosen, and don't expect too much out of something. So even from mid caps or small caps, if the long term historical average is let's say high teens, then to expect that they will give you 30% every 2 years CAGR is not going to happen. It may happen once in a while, like it did, but then there will also be reversion to historical mean on that. And of course, long term patience will always pay off. There is no doubt about that. So let me know in the comments your time horizon for equity investments. How are you holding up? I hope these data points are giving you confidence to do that. Once you go through a couple of such cycles, I can almost guarantee you will not get bothered at all, because then you would have realized that this is the nature of the market, and you have to bear this to really come out good on the other side. Thank you so much for watching. Do like and share these videos, and do subscribe to the channel. Thanks. Bye.